If you're going to watch any of my videos, this is the one that you guys really need to pay attention to. With the recent developments that have happened in the global economy over the last about 4 months here, we've been signaling that things are not healthy in the overall market and something was bound to break. Now today, we recently got more news and it just kind of confirms what we've been saying for a while, that our markets and the people in charge, the policymakers, have made all of the financial markets around the world an absolute clown show. And at the end of the day, the people that are actually going to be getting hurt from this are just the normal everyday people. So we need to talk about this situation that's unrolling here, the market, the 10-year treasury yield, the dollar, and break this all down for you guys in a very simple and easy to understand way. Because if these types of actions are going to spread into other countries, we are not going to be getting that light at the end of the tunnel that we've been talking about on this channel for some time. So again, guys, before we get into all of this information, if you do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who do want to learn. And again, if you do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So when we pull up the chart of the SPY, the SP 500 ETF right here, looking at this on the daily time frame, well, we saw that we had this nasty cross down. We've been selling off for 6 consecutive days here, and we are seeing a little bit of relief after making these new lows yesterday. Now, again, you are seeing the RSI on this daily time frame starting to pitch back up towards its moving average. The ADX also is building that bearish momentum here again as well. And overall, we are going to be looking towards a couple of these key levels here, that 372.50, that 370 level that we rejected off today at the current time that I'm recording this video. But what we need to look at here is, well, we have the dollar absolutely tanking today. Now, the dollar has been on a pretty meteoric moon mission over the last couple of weeks and months, just due to the overall tightening of financial conditions in the overall markets, in the overall economy as well. Now, the other thing that we've been pointing out is the 10-year treasury yield. And we've been talking about this concept of TINA, there is no alternative. We've seen these 10-year treasury yields and all the treasury yields really starting to pick up over the last couple of weeks here. Now, what exactly happened today that caused these really, really drastic and aggressive moves? Well, quantitative easing is back. Now, the way that I kind of was thinking about quantitative easing here, it's a tool that a lot of these policymakers are going to use as a crutch to get them out of sticky situations. But what you can really think of it as is like you have a terrible ex-girlfriend that you just cannot stay away from, even when things are looking pretty terrible here. That's essentially what's going on with this quantitative easing situation in all of these markets here. So coming over to this tweet right here, the Bank of England joins Japan. We now have 3 groups: the ones suppressing rates at the cost of their currency, Japan and the Bank of England; the ones protecting their currency and at the cost of their bond market, the US and Brazil; and the ones letting their currency and bond market collapse, the ECB and others. Now, what exactly happened today? Well, when we come over here, the Bank of England stepped into Britain's bond market to stem a market rout, pledging to buy around 65 billion pounds or 69 billion US dollars of long-dated gilts, their equivalent of treasury yields, or the United States treasury yield, treasury bonds, after the new government's tax cut plans trigger the biggest sell-off in decades. Citing potential risk to the stability of the financial system, the BOE, the Bank of England, also delayed on Wednesday the start of a program to sell down its 838 billion pounds, 891 billion USD of government bond holdings, which had been due to begin next week. When you see these large government institutions starting to buy bonds, that is quantitative easing. That is a program that we do not really need in our current marketplace. Is this necessary at the current time in order to stem that financial disaster that we could be seeing over in the European markets? Yes. But what this is essentially doing is putting a band-aid on a gunshot wound. It's further just delaying and kicking the can down the road and trying to mask the actual issues that are actually out there in the market right now. Buying bonds to try and suppress these yields and control their currency is a short-term measure to a long-term problem. So thinking about this situation here, This is not good. If we start to see other countries as well starting to buy their own bonds in order to control their yields, we are going to go back into that quantitative easing period that we were seeing in 2020. Now, you might be thinking, well, the stock market's green today. Well, okay, the stock market's green on one day. Could it continue to rise up? Yes, it definitely could on this relief bounce, but is that actually going to solve the actual problems that are out there in the economy and getting us back towards a period where we could actually see some normal growth and get back to kind of the inverse of what we're in right now, which is an unreasonable marketplace? Now, the other thing that we need to go over here is a couple of things. One, behind the Bank of England's panic, billions in margin calls, death spiraling into a complete bond market collapse. It's only fitting that literally hours after the most clueless, I don't know what they're referring to here. I mean, I'm not going to say that, but in capital markets history, Janet, no crisis in my lifetime, Yellen said the financial markets are functioning well. All right, if you guys like my Janet Yellen impression, make sure you guys hit that like button down below. But that the Bank of England literally panicked and shocked markets by resuming unlimited QE, quantitative easing. We haven't seen liquidity problems develop in markets. We're not seeing, to the best of my knowledge, the kind of deleveraging that could signify some financial stability risk, Yellen said in answering reporters' questions on Tuesday. Fast forward to just a few hours when the Bank of England saw quite a few, quote, liquidity problems when it cited significant repricing of UK and global financial assets. This repricing has become more significant in the past day, and it is particularly affecting long-dated UK government debt. It warned that were dysfunction in this market to continue or worsen, there would be a material risk to UK financial stability, meaning a very significant collapse. Now, what does this tell us about the overall market and what these policymakers are willing to do? It means that if we are headed towards a situation where things could get very, very bad, well, they are just going to step in with their money printer and try to solve some of these problems. You might hear that this might be a good thing or that this is going to provide some short-term relief to markets here. Yes, it might, but again, it's a short-term solution to a problem that is not going anywhere. And again, along with this, when you see kind of putting this into perspective here, this whole situation with how much money has been lost during this time frame, drawdown in total market capitalization of US equity and fixed income markets, there has been about $57.8 trillion of market value lost. That is very, very significant. Now, thinking about what is going on in our markets right now and how things could potentially get better, well, we are really back into quote unquote no man's land with back here in the United States of what the Federal Reserve is actually going to do. Is Jerome Powell actually going to come out and adopt some policies like this if he wants to control the previously rising yields of the 10-year Treasury? I mean, I would say that it's unlikely since we are going into more restrictive policy. We are projecting more rate hikes to come out. But this situation is not good here. The fact that the Bank of England was citing such significant problems in their system not only tell us that, one, these issues are very, very prevalent in our marketplace right now, but that they also didn't act fast enough in getting these problems actually under control when they first started to arise a year and a half ago. Now, you can liken that to what's going on in the United States, in Japan, in China, in Russia, in any of these other large, basically economic players in the global economy here. The Fed has been asleep at the wheel, and we are waiting, basically hanging by a thread to see how successful the Fed is going to be at playing this game of operation with the overall economy. So again, guys, protect yourselves. It's going to get pretty nasty out there and very, very volatile. So that's going to wrap it up for this one. If you guys did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. Other than that, guys, I'll see you at Late Night Fix tonight. Peace.